Welcome, students. As we are coming to the end side of this topic, budgets, let's look at this example. Phonex Limited produce and sells three types of electronics gadgets. We have gadget alpha, gadget beta, gadget gamma. The company wants to prepare a detailed sales budget for the next year. The following information is provided. So the budget that the company is expected to prepare, this is the following information. Looking at the budgeted sales volume that the company is expected based on their budget preparation, for alpha is 50,000 units, beta 40,000 units, gamma 30,000 units. Let's look at their selling price. Alpha $80 per unit. Remember, this selling price is per unit. Beta $100 per unit. Gamma $120 per unit. Additional information. 1. They said the company policy is to maintain an ending inventory of 5% of the next month's sales volume. The beginning inventory, that is the ending 5%. The beginning inventory for gadget alpha, beta, and gamma is 2,000 units for alpha, 1,500 units for beta, and 1,200 units for gamma, respectively. 2. The production cost per unit is $50 for alpha, $70 for beta, and $90 for gamma. 3. Variable selling expenses are 10% of the sales revenue for each product. 4. Fixed selling expenses are 20% per month. That these fixed selling expenses is constant, is unchangeable. The company expects a 3% monthly sales increase for all the targets. It means there is an expectation of increments as the month progresses. Let's look at the requirements now. 1. They say prepare a sales budget for each month showing the expected sales volume and the sales revenue for each product. 2. Calculate the total variable selling expenses and fixed selling expenses for each month. 3. Determine the cost of goods sold, that is the COGS for each month. 4. Prepare a budgeted income statement for the first quarter, considering sales revenue, variable selling expenses, fixed selling expenses, and the COGS. This is the question requirements. Now, how are we going to determine this nature of question? Remember, they said let's consider the first quarter. It means we are only going to concentrate on January, that is month 1, February, month 2, and March, month 3. Let's look at the solution, how it works. Now, when we look at a solution based on the requirements, They said, prepare a sales budget for each month showing the expected sales volume and the sales revenue for each product. Now, let's look at the sales budget for each month. For January, we indicate the names, the sales volume. This is the sales volume. That is what we call the projected sales volume. And we have the selling price, we have the amounts. Now, we indicate all these projected sales volume under this sales volume column units. We indicate their names and their unit of volume. The selling price, remember this selling price is per unit. We indicate the selling price again. Then, what happened? For us to determine the expected sales for each person is when multiplying the sales volume towards the selling price will give us the sales revenue for each person. Looking at alpha, 50,000 units of volume produced at a cost of $80. When we multiply it, it gives us $4 million. Beta, 40,000 sales volume multiplied by $100 give us $4 million. Gamma, 30,000 sales volume multiplied by $120 give us $3,600,000. But of course, the first phase of this, we have done it. This is the expected sales revenue for each person. For us to determine the total sales, because the essence of determining the total sales is to ensure you determine the total variable selling expenses. That is why we decide to use it in a tabular form. Now, the total sales revenue is when we add this amount here, give us this total, as we are saying. Let's look at the second month. We are still under the sales budget, preparing the sales budget. When we look at February, there is an increase of 3%. Looking at the additional information, they said the company expects a 3% increase sales. So there is an increase of 3%. So whenever there is a percentage increase, and what happened? This percentage increase will be added plus 1. The 1 is always constant. Now, we indicate the names, the sales volume that is provided under the projected sales volume here. We indicate them here again. This one, we indicate them here. We indicate a 3% increase. The 3% increase here, this one we are saying is constant, added by this percentage given, the 3%. When we convert it, it gives us 0.03. So when we add the 1 plus 0.03, give us 1.03 respectively. Are we seeing? Then this one now we say current sales volume, because there is an increase of 3% immediately after January. There is an increase in February, 3%. So therefore, we are not going to use the sales volume that is provided in the question again for February. For us to determine our current sales volume is when we multiply this sales volume multiplied by the 3% increase. That is 50,000 sales volume multiplied by 1.03 give us 51,500 sales volume current. So it means on February, we have Mr. Alpha quantity was 51,500. And what is the selling price of it? $80. So when we multiply this, it will give us $4,120. Beta, $40, 40,000 units of volume multiplied by 1.03 give us 41,200 quantity of volume or units. We multiply this by the price, that is the selling price, 100. It gives us this amount. The same thing again for gamma we do. Then we add. It gives us our total sales as we are seeing the amount. Then for the other month again, that is for March. March, there is also an increase of 3% again. We indicate the name, the sales volume, the 3% increase, the current sales volume, the selling price, and the amount column. But remember, when we calculate for January, we use the sales volume in the question, that is the projected sales volume in the question. But when we move to February now, for us to determine the amount, we use the increase percentage given plus the 1 multiplied by the sales volume that gives us an current sales volume. So when we move to February now, the current sales volume in February will be indicated here. This current sales volume, all this current sales volume will be indicated here. We put again the 3% increase. We do the same thing. The 1 here is constant. We convert this 3%, it will give us 0.03. That is 3 divided by 100. So when we add 1 plus 0.03, give us 1.03. So it's indicated here respectively. Now, we want to know the current sales volume for March. So when we multiply the sales volume that we take from February, that is the current sales volume in February, we take it and multiply it to this increased percentage given, it will give us for alpha 53,045 quantities or units of volume produced. What is the selling price of each? Is $80. So when we multiply the 53,045 current sales volume multiplied by the selling price $80 give us $4,243,600. The same thing applies to the following, as you can see. Then we add the total. This total is what we call the total sales. Are we seeing? So this is how we calculate for the sales budget for each month. So we have done with the first requirement. Are you seeing? Let's look at the second requirement. Calculate the total variable selling expenses and fixed selling expenses for each month. Let's look at it, how it works. Now, the total variable selling expenses for each month. We look at January. We said the variable selling expenses is equals to the percentage. What percentage are we talking about here? Let's look at the question under the footnote or additional information. Here, they said Roman 3, they said variable selling expenses are 10% of the sales volume for each month. So the 10% will be given to all the months provided: January, February, and March. Now, we said 10% percentage of the total sales. And what total sales here is the sales that we calculate under the sales budget for each month. This sales that we are seeing here for January is what we are going to take. Now, we said 10 upon 100, percentage is sum up to 100, times, we are working for January. So we are going to take this total sales. We look at the total of it. $11,600,000. So this is what will be taken here. So when we multiply this, this is our variable selling expenses. We do the same thing for February. The 10% is constant, multiplied by what is our total sales for February. Our total sales for February is $11,948,000. It will be taken here. Are we saying? So when we multiply this, give us this amount as our variable selling expenses for February. The same thing apply for March again. The 10% multiplied by the total sales for March. The total sales for March, 12,306,440. $12,306,440. So is what we indicate here again. So when we indicate it here, multiply it, it gives us this amount as our variable selling expenses for March. Remember, the requirement says let's find the total variable selling expenses and the fixed selling expenses. So we have found the total variable selling expenses. For us to determine the fixed total selling expenses, let's look at it. For January, we said the fixed selling expenses is equals to the variable selling expenses plus the fixed selling expenses. Are you saying, what is the variable selling expenses that we're talking about here? Is this variable selling expenses that we have just calculated for this following month? Now, since we are calculating for January, what is the total variable selling expenses for January? Are we saying this is the total variable selling expenses for January? So this amount is what we are seeing here, plus the 20,000 here is fixed, is the fixed selling expenses. It is in the question under the additional information. They said fixed selling expenses are $20,000 per month. So each month is $20,000. So it's constant. So when we add this, it gives us $1,180,000 for January as a total fixed selling expenses. Are we seeing? Now, let's look at for February. When we look at February, we said the total fixed selling expenses is equals to what is the variable selling expenses total for February. We have $1,194,800 is what we are seeing here, plus the 20,000 fixed selling expenses that is provided under the footnote. So when we add it, it gives us these amounts for February. We move on to March. When we look at March, what is the total variable selling expenses for March? when we calculate, this is the total variable selling expenses for March, is what we are seeing here, plus the $20,000. So it gives us this amount for March as a total fixed selling expenses. Now, we have done with the second requirement, requirement 2. Let's look at requirement 3. They said determine the cost of goods sold, bracket COGS, for each month. Let's determine the cost of goods sold now. Now, for January, for us to determine the cost of goods sold, we look at the projected sales volume for January. This is what we are going to use for January. The projected sales volume for January that we are seeing here. But the selling price that we are going to use is not the selling price that we are seeing here. Are we seeing? But we are going to use the selling price that is provided under the additional information. They said the production cost per unit is $50 for alpha, $70 for beta, and $90 for gamma. Are we seeing? So this is our selling price that we are going to use to determine the COGS. We are not using this selling price anymore. We are using this selling price that is provided under the additional information. So we make our tabula again. We say names, sales volume, selling price, amounts. Why are we using this sales volume? It's because for January, we use the sales volume that is provided in the question. But for the following month, we use the sales volume based on the increase of 3% given to us. Now, we said 50,000 sales volume multiplied by the selling price, that is $50, it gives us $2,500,000 for alpha. 40,000 sales volume multiplied by $70 gives us $2,800,000. Gamma. 30,000 sales volume multiplied by $90 give us $2,700,000. The essence of preparing the COGS is for us to know when we are going to prepare our budgeted income statement, because we want to know the total COGS for every month. So looking at January, the total COGS for January is what? $8 million. Are we seeing? We move on to February. But remember, when we move to February, we are not going to use the projected sales volume that is given in the question, because there is an increase of 3% for February and March. So therefore, we are going to use the 3% increase current sales volume provided. Are we seeing? Go over again under the sales budget when we prepare it. Are we seeing? For February, these are the current. This one, these numbers that we are seeing here is what we indicate under this column now. Are we seeing? But the selling price is constant. The only thing that's changed is the sales volume, because there is an increase in percentage for the following months. Remember, as I said, the essence of preparing the COGS is to determine the total COGS that will be taken to the preparation of the budgeted income statement. Now, we implement the same thing, as you can see. 51,500 sales volume multiplied by 50, it gives us $2,575,000. 41,200 sales volume multiplied by $70 give us $2,884,000. Gamma 30,900 sales volume times $90 give us $2,781,000. So as when we add all these total, it gives us $8,240,000. Let's look at March. When we look at March, remember for March, when we solve for the sales budget for each month under March, there is an increase. So we come to March. Under March, the current sales volumes, as you can see them, these current sales volumes are what we take and bring it here when preparing our COGS for March. So we indicate it here, as you can see. So these are the current sales volume. The selling price remain constant that is provided in the footnotes. Are we saying? So we multiply this. When you multiply this number to this, it gives you this amount. So as at the end of the day, this is the total COGS for March. Then the next requirement is for us to calculate the budgeted income statement. So we are about to calculate the budgeted income statement. But when calculating the budgeted income statement, remember, you have to take into consideration your revenue or your sales that is prepared. Remember, the first requirement to prepare the sales budget. And the essence of preparing it is for us to determine the total sales. And this total sales will be taken under this budgeted income statement. Now, let me go with you back again. When we look at the sales budget for January, the total sales, are you seeing the total sales amount? $11,600,000 is what we are taking for January. Are we saying sales or revenue? Are we saying it? When we come again for February, are we saying the total for it for February? We take it for February. Are we saying when we come again for March, we take the total sales for March here again under the budgeted income statement? That is why we said revenue or sales. Then the next item consider is the COGS. Under the COGS, what is the COGS for January? The COGS for January, the total COGS, $8 million for January. For February is what? $8,240,000. Are we saying $8 million? $8,240,000. And what is for March? For March, $8,487,200. Are we saying it? $8,487,200. Then the next item we consider is our variable cost or variable selling expenses. And what is our variable selling expenses? Of course, we calculated it. This is our variable selling expenses for January. As we can see, $1,160,000 is what is indicated here, but in a form of deduction or subtraction. We have to subtract it. That is why it's in a form of brackets. all the variable selling expenses, these are expenses, so we have to deduct them from the sales and the COGS. Are you saying? So we are going to consider again for February variable selling expenses total. As you can see, 1,194,800 is what is indicated here. 1,194,800 in a form of brackets again. When we move to March, the same thing. We take this amount, the total amount for March for variable selling expenses, and bring it here again for the budgeted income statement. The fixed cost, of course, this is constant. We take these amounts from what? The additional information. We stated it very clear. It said the fixed selling expenses are 20% per month. So we are going to indicate it from the above months that we are seeing in a form of deduction. Are you seeing? So you have to add these two, you subtract these two, it give you for January. Our budgeted income statement for January is $18,420,000. For February is $18,973,200. For March, $19,542,996. Are we saying? So this is the end of this question. Thank you very much.